Imagine waking up to find that every dollar you own is suddenly worth half as much. It sounds like a wild magic trick, right? But when you look at what's happening in Washington and how the government is handling the national debt, that scenario might not be as far-fetched as it seems. Let's break down what's really going on. Recently, there's been a lot of buzz about the US government's debt levels hitting new records. We're talking over $34 trillion and counting. To put that in perspective, that's more than the entire US economy produces in a year. Every time the government spends more than it brings in, it borrows the difference, mostly by issuing treasury bonds. These are sold to investors, everyone from big pension funds and foreign governments to regular folks who want a safe place to park their money. Now, here's where it gets tricky. Treasury bonds have long been seen as one of the safest investments out there. After all, they're backed by the full faith and credit of the United States. But with the US borrowing so much, some experts are starting to question just how safe these bonds really are, and more importantly, whether holding them is truly a smart move for everyday investors like you and me. Let's talk about how this system actually works. When you buy a treasury bond, you're essentially lending money to the government. In return, the government promises to pay you interest, plus your original investment, back at the end of a set period. Sounds fair, right? But here's the catch. If inflation rises faster than the interest you're getting paid, the real value of your money actually goes down. And lately, inflation has been doing just that, running hotter than the interest on a lot of those bonds. For example, in the last couple years, inflation in the US has hovered around 3 to 4%, sometimes even higher. Meanwhile, some treasury bonds have been paying out less than that. So, if you're earning 2% interest, but prices are going up by 4%, you're effectively losing money in terms of what your dollars can actually buy. So why does Washington seem okay with this? Well, it all comes down to the government's debt problem. If inflation rises, the real value of the money the government owes actually shrinks. Think about it. If you have to pay back $1 trillion in the future, but the purchasing power of a dollar has gone down, it's like paying your debts with cheaper dollars. In other words, inflation becomes a sneaky way for governments to reduce the burden of debt, at least on paper. This isn't a new trick either. There's a long history of governments using inflation to get out from under mountains of debt. After World War II, for example, the US had a massive debt load relative to the size of its economy. Over the next few decades, a combination of economic growth and moderate inflation helped shrink that debt relative to GDP, even though the actual dollar amount didn't change much. But here's the thing. This trick doesn't really help regular investors. If you're holding treasury bonds or even just cash in the bank, rising inflation means your money buys less and less over time. Meanwhile, the government gets to pay back its IOUs with dollars that aren't worth as much as when you first lent them. To make matters worse, the demand for treasury bonds is starting to look shaky. In the past, foreign governments like China and Japan snapped up US debt because they saw it as a safe bet. But lately, both countries have been pulling back, and that means the US government has to work harder and pay higher interest rates to attract buyers. That might sound good if you're a new investor looking for higher yields, but it also means the government's debt burden gets even heavier. It's a bit like being stuck in a cycle. The more you borrow, the more you have to pay to borrow next time. Now, there's another angle here that's important to understand. When the government borrows more and more, and the Federal Reserve keeps interest rates relatively low, it can encourage riskier investing behavior elsewhere. People looking for higher returns might start putting their money into stocks, real estate, or even speculative assets like cryptocurrencies. That can drive up prices and create bubbles, making markets more volatile and, frankly, more dangerous for average investors who just want to protect their savings. So what does all this mean for you? Well, it's a reminder that safe investments aren't always as safe as they seem, especially in an environment where inflation is eating away at purchasing power. If the government keeps borrowing at this pace, and if inflation stays elevated, it's everyday savers and bondholders who will end up footing the bill. Some experts suggest diversifying your investments, mixing in assets like stocks, real estate, or inflation-protected securities like TIPS, which are designed to keep up up with rising prices. Others recommend keeping an eye on the big picture, watching how Washington handles the debt, and making sure your investments can weather whatever comes next. At the end of the day, the government's magic trick of using inflation to reduce its debt might work for politicians and policymakers, but it can leave regular people feeling like the rug's been pulled out from under them. The key is to stay informed, stay flexible, and make sure your money is working as hard as you are. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more clear, straight-talk insights on what's happening in the world of money. As we watch Washington's next moves, one thing's for sure: the value of a dollar and how to protect it will always be worth paying attention to. What do you think the next trick will be? Let us know your thoughts, and as always, stay smart with your investing.